Welcome. In this video, Zbcn coin 800%. In this video comes a hard bullish wave. We will analyze it. Don't forget to subscribe, don't forget to like, and please watch to the end to understand. A downtrend in technical analysis refers to a price movement where the asset consistently forms lower highs and lower lows over a certain period. These trends generally indicate that the market is under pressure in the short or medium term, and that sellers are dominating. A price breaking the downtrend line is a critical point technically, as this breakout signals a potential shift in trend direction and that buyers may regain control of the market. The downtrend line mathematically represents a level where the price meets resistance and sellers exert pressure, and as long as the price cannot surpass this line, downward pressure continues. However, breaking this line creates a turning point in the market and allows price movements to gain upward momentum. When the price breaks the downtrend line, this breakout is not just a price movement, it also reflects a change in market psychology. Sellers' control weakens and buyers become dominant. This process creates a strong positive shift in the perception of investors and traders. Especially in cases where the trend has been downward for a long time and market participants expect further declines, breaking the downtrend is perceived as a signal of confidence and increases buying pressure. This allows the price to rise more quickly and strongly. From a technical perspective, when the downtrend is broken, the trend line that previously acted as resistance can turn into a support level. This phenomenon is known in classic technical analysis as resistance to support conversion and is critical for sustaining upward price movement. The trend line acting as support after a breakout stabilizes the rise and ensures that buyers remain in the market even during pullbacks. This strengthens the foundation for the trend change and increases the continuity of the upward movement. Additionally, a downtrend breakout is considered a more reliable signal when evaluated alongside momentum indicators. Momentum measures the speed and strength of price movements, and increasing momentum during a downtrend breakout indicates that the upward movement is likely to be strong and reach significant levels quickly. This allows investors to open positions more confidently and take advantage of bullish opportunities. Breaking the downtrend also has a profound effect on investor psychology. Market participants perceive that opportunities are emerging and that prices may begin to rise when a long-term downtrend is broken. This triggers buying decisions and creates a positive feedback loop in the market. As prices rise, buyers open more positions, further strengthening the upward movement. This demonstrates that a downtrend breakout is not only a technical event, but also significant in terms of market psychology and perception. A trend breakout also provides a strategic reference point for long-term investors. Breaking the downtrend helps investors set target prices and optimize risk management strategies. Investors can plan position sizes and entry-exit points based on potential upward movement after the breakout. This increases profit potential while minimizing downside risk during possible pullbacks. Breaking the downtrend also generates increased liquidity, higher volume, and overall positive market sentiment. Rising trading volume at the breakout point supports the reliability of the movement and prevents false breakouts. A volume-supported breakout indicates that buyers are strongly present in the market and that the upward movement is sustainable. Breaking the downtrend line carries multifaceted significance in technical analysis. It provides short-term traders with quick profit opportunities and signals trend reversal for medium and long-term investors. The breakout changes market perception, increases buying pressure, and enables prices to reach new highs. In conclusion, a price breaking the downtrend is a critical signal in technical analysis. This breakout is a strong indicator that can change the direction of price movement, increase momentum, and positively influence market psychology. Breaking the downtrend allows investors to optimize positions, manage risk, and maximize benefits from the continuing trend. With the trend line broken, upward price movement strengthens, the bullish trend becomes clearer, and buying pressure increases. This process creates a robust, bullish environment supported by technical analysis, volume dynamics, and investor psychology. A price breaking the downtrend line is not just a mathematical breakout, it marks a turning point where market perception, investor behavior, and trend direction become clear. However, we can't rely solely on trends for analysis. Let's also look at other metrics. Stay tuned.
The RSI indicator is an important tool in technical analysis used to measure the speed and momentum of price movements. RSI is particularly useful for identifying overbought or oversold areas, providing investors with signals about potential reversal points. A downtrend forming on the RSI indicates weakening momentum, limited buying strength, and that the market is under short-term pressure. This downtrend represents a pattern of consistently lower highs and lower lows on the RSI, and is interpreted as a sign that market momentum is weak. However, a breakout of this downtrend on the RSI is a critical signal for the market and presents significant opportunities for investors. A breakout of the downtrend on the RSI technically indicates that momentum is gaining upward strength again. This breakout signals that price movements may have a stronger potential for an upward move. The stronger the price action, the more solid and reliable the RSI breakout signal becomes. This creates a critical reference point for both short-term traders and medium to long-term investors. When the RSI breaks its downtrend, market participants recognize that momentum has shifted in favor of buyers and that selling pressure has weakened. This awareness triggers buying decisions and creates a positive feedback loop in the market. Breaking the downtrend on the RSI also has a psychological effect. The breakout of this momentum indicator increases investors' perception that the market is likely to move upward, strengthening buying pressure. Investors observe the RSI breakout and anticipate that the price will gain upward momentum, adjusting their positions accordingly. This is reflected in increasing buying volume and rising prices. Particularly in markets that have been in a prolonged downtrend, an RSI breakout is seen as a strong confidence signal and positively impacts market psychology. From a technical standpoint, one important factor to consider when the RSI downtrend is broken is volume and other momentum indicators. If the RSI breakout is supported by high volume, the reliability of the breakout increases, providing a strong indication that price movements will be more sustainable. A breakout without volume may be a false signal and pose a risk to investors. Therefore, when the RSI downtrend breaks, it is critical to evaluate it alongside other indicators and market conditions to make informed investment decisions. An RSI downtrend breakout is a classic technical analysis signal of trend reversal. This breakout indicates that upward momentum is increasing and buyers are becoming dominant in the market. The occurrence of this breakout allows prices to gain upward momentum and increases the potential to surpass previous resistance levels. Investors following the RSI breakout gain confidence that the price is entering a bullish trend and can open positions accordingly. The breakout of a downtrend on the RSI also influences investors' strategic decisions. Short-term traders may see the RSI breakout as a buying opportunity and capture quick gains alongside rising prices. Medium and long-term investors can use this breakout as a signal that a trend change has begun and open strategic positions in their portfolios. In this respect, the RSI breakout serves as a guide for both short-term opportunities and long-term investment strategies. Breaking the RSI downtrend also triggers a positive feedback mechanism in price movements. As momentum starts moving upward, buyers buy, prices rise, and the RSI strengthens further. This process is reinforced by the positive cycle between price and RSI and can support the continuation of the upward trend. Therefore, the RSI breakout is not only a technical indicator, but also an important signal reflecting changes in market psychology and investor behavior. An RSI downtrend breakout is also important for risk management and position optimization. Since the breakout signals that prices may move upward, investors can adjust position sizes and entry-exit points accordingly. This maximizes profit potential while minimizing risks during possible pullbacks. The RSI breakout allows investors to approach market movements more consciously and strategically. In conclusion, a breakout of a downtrend on the RSI indicator is a critical turning point in technical analysis and market psychology. This breakout shows that momentum has gained upward strength, buyers are becoming dominant, and price has increased potential for upward movement. The RSI breakout is an important signal for both short-term traders and long-term investors, serving as a multifaceted indicator that supports price action and positively influences market perception. Its occurrence allows investors to optimize strategic decisions, accurately follow trend changes, and interpret it as a strong technical signal that can generate upward momentum in the market.
The inverse head and shoulders pattern is considered a very strong model in technical analysis, especially for indicating trend reversals. This pattern typically appears at the end of downtrends and signals that buyers are gaining strength while sellers are weakening. The pattern consists of three main parts: the left shoulder, the head, and the right shoulder. The left shoulder represents a short-term price rise within the downtrend, followed by a decline.
The head is the lowest point, falling below the previous low, representing the peak of selling pressure in the market. The right shoulder is the price movement that follows the head, generally forming a rise and decline near the levels of the left shoulder. Completion of this structure indicates technically that the trend has shifted from downward to upward and that the price has high potential to move upward. If the price is currently forming the final shoulder in the inverse head and shoulders pattern, this is a critical period. The final shoulder signals that buyers are becoming active again and selling pressure is decreasing. Completion of this final shoulder, followed by an upward move, can allow the pattern to reach its target level. Technically, the target of the inverse head and shoulders pattern is calculated based on the depth of the head, which serves as a key indicator of the potential upward price movement. Proper completion of the pattern allows the price to surpass previous resistance levels and confirms that the trend has clearly changed. Since the target of this pattern is equal to the depth of the head, the potential percentage increase can be substantial. For example, the difference between the head's low and the starting level of the pattern determines the maximum distance the price may rise. This measurement is critical for investors in adjusting their positions, setting target prices, and planning risk management strategies. Investors can open positions while waiting for the price to reach this target and maximize gains from the upward movement. During the period when the price is forming the final shoulder, momentum indicators and volume analysis are also very important. If the price initiates an upward move after completing the final shoulder, and this move is supported by volume, the reliability of the pattern increases and the likelihood of reaching the target rises. An increase in volume indicates that buyers are active and selling pressure is diminishing. This enhances investor confidence and creates a positive feedback loop, supporting faster upward movement. The psychological aspect of the pattern should not be overlooked. The inverse head and shoulders pattern creates a strong perception in the market that the trend is changing. As the final shoulder completes and the upward move begins, investors may accelerate their buying decisions, increasing buying pressure in the market. This psychological effect facilitates reaching the target level and enhances the sustainability of the upward trend. Especially in markets that have been in a prolonged downtrend, completion of this pattern signals critical investor confidence and initiates positive market momentum. From a technical perspective, the target of the inverse head and shoulders pattern anticipates an upward movement equal to the depth of the previous head. This target serves as a strategic reference point for investors and provides a clear prediction of potential price levels. The pattern's target indicating approximately an 880% increase demonstrates its strength and the potential gains it can generate in the market. Investors can open positions according to this target, manage risk, and maximize the benefits from the upward move. During the period when the price is forming the final shoulder, momentum indicators and volume analysis are also very important. If the price initiates an upward move after completing the final shoulder, and this move is supported by volume, the reliability of the pattern increases and the likelihood of reaching the target rises. An increase in volume indicates that buyers are active and selling pressure is diminishing. This enhances investor confidence and creates a positive feedback loop, supporting faster upward movement. Completion of the inverse head and shoulders pattern allows the price to surpass previous resistance levels and confirms a clear trend reversal. This process guides investors in both short-term profit opportunities and long-term investment strategies. The formation of the final shoulder and subsequent upward movement is the fundamental mechanism for reaching the pattern's target. This creates a strong bullish signal in the market, both mathematically and psychologically. In conclusion, the inverse head and shoulders pattern is one of the most reliable indicators of trend reversals in technical analysis. The fact that the price is currently forming the final shoulder is a critical signal for the realization of this upward potential. The pattern's target is calculated based on the depth of the head and offers approximately an 880% potential increase. This pattern serves as a strong reference point in both investor psychology and technical analysis, and reaching this target allows the bullish trend to become clear and buyers to gain strength. The inverse head and shoulders pattern is a versatile and critical technical analysis tool that enables investors to optimize strategic decisions, set price targets, and accurately assess market momentum.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.